this is the last lesson to the Invest for Retirement step as part of the Winning with Money process. And today we're going to focus on how we can start investing for retirement. So there's four main types of retirement accounts. The first one we're going to cover is individual retirement accounts, or IRAs. And I like to cover this one first because anyone can start it. Anyone 18 or older can start it. If you're younger than 18, then you can get your parents started or a guardian to start it as a custodial account. But anybody, anywhere, any job, any occupation, you are allowed to start an IRA, an individual retirement account. The first one we're going to cover is a Roth IRA. And Roth IRAs are contributions that you can make into that retirement account after tax. So your income tax, after income tax is taken out, the IRS will set a $6,000 limit on a Roth IRA as of 2022. And then that's the amount that you can put in. You can put more than that, but to have the tax benefits, you can only put $6,000 of after-tax money. What's cool about Roth IRAs and any IRA is we can control, the individual owner can control the investments that you pick, that you choose. And one of my favorite things about a Roth IRA is all the gains, all the capital gains, the dividends, any growth that the account sees in your investments over time grows tax-free. So it's the whole entire growth, any other contributions you put in, dividends you earn, all that grows tax-free until you retire. When you retire, and then IRS states at 59 and a half, you can begin withdrawing. When that retirement age comes, the withdrawals are tax-free because, again, we're talking about after tax. So Roth IRA, after tax, income tax has already been taken out. So growth and withdrawal, all tax-free. On the other side of things, you have traditional IRAs. So traditional IRAs is before tax income. So this is money that you have not been taxed on. And the IRS deals with this the same way they deal with a Roth IRA. You get a $6,000 limit on traditional, on any IRA really. But before income tax contributions, this also means that you get a $6,000 deductible. So whenever you're doing your income tax returns, in April or March or whenever you do it before April 15, you can write off $6,000. And they usually, if you go through some type of tax program like TurboTax or TaxSlayer, they'll usually ask you, did you contribute any to a traditional IRA? And you can do up to $6,000 on that. Now the only bad thing, a traditional IRA, you also individual controls investments, but gains are taxed. That's the only downside to it. All the gains, all the growth in the IRA are taxed, and when you withdraw, whenever you withdraw at retirement, that income is also taxed. The other category of retirement accounts are employer-sponsored retirement accounts. So a lot of us, we see these codes, we see these numbers, and we usually don't know what they mean, but a 401k is the most common type, and it's made for for-profit businesses. So most companies are going to have a 401k. And how this works is employees can take money out of their paycheck each month or whenever you get paid, each pay period, and you can contribute to this 401k retirement plan. And some employers will match it. They'll match a portion of it as part of their benefits package to keep more people into their business, or they'll match the complete limit, which is awesome. So usually it's anywhere between 3 to 10%. I've seen some different ones, but usually it's somewhere between 3 to 10% that they'll match of your income to that retirement account. So you put in $10, they put in $10, and you keep doing that until you reach the capped limit. Individuals, they are capped at $20,500 as of 2022. So that's the max contributions you can make to your 401k for that year. The only thing bad I don't like about 401ks is the fund manager controls the investment. So what happens is your business is hiring a third-party fund manager or account manager, and then they run the whole entire investment scheme. Some jobs you might have, some 401ks, you might have a little discretion on how investments can go, but most of the time you don't have any say in a 401k. There are different types of 401ks. Some employers will have a Roth 401k and a traditional 401k, and some have a mix of both. Some have hybrid modes. So just understand, which your job and your employer, which one do they have? And when we leave, it's a little difficult of a process. I've had to do it a couple of times, but when you leave a job, that money that you have in that IRA is yours. So make sure you cash it out. Well, I'm sorry, don't cash it out. Roll it over. If you cash it out, then you get hit with a big penalty. But if you roll it over into another IRA or some other qualified retirement account, then you get that money without having to worry about paying any fees. Just make sure you take your money with you when you leave. The other type of 401k is known as a 403b. So the difference here is 401k is for profit, 403b is for nonprofit organizations, for nonprofit employers. So nonprofit contributions are matched, just like we see in a 401k. We also, if you're in a 403b, you don't get much say. I've seen some 403bs that get a little more control of at least what funds they can be invested in. So if they want to like choose aggressive or conservative or stuff like that. And 401ks might have that too. Again, I haven't seen every single company, but just know, talk to your HR, talk to your finance department to understand, what type of investments that you can be involved in and how much control you have over those investments. And 403bs also can be Roth versus traditional, and just make sure we roll over those funds into another retirement account whenever we leave. So the big point here, if you can't start an IRA, you can't start an individual retirement account, at the very least, you should max out your 401k, 403b, because that is free money that you're leaving out if you're not maxing out those contributions. So say your company offers 6% contributions, you're only putting in 3%. That's 3%, that's gonna be hundreds of dollars for some people. That's 3% that you're leaving out that your company would be matching if you were maxing it out. So make sure, go talk to your HR department, your finance department, whatever it is, talk to them, make sure that we are maxing out the contributions, because if you're matching 6% and you're maxing that out, your company's putting that money in, and that's just free money that you're leaving out if you're not doing it. Other types of retirement accounts, so those other four were the four main ones. Other types of retirement accounts, or kind of like hybrid retirement accounts that you could use for retirement funding. Self-employed IRA, or also known as a simplified pension, or SEP IRA. It's great for people who own a business and have employees or are the sole owner, business owners, freelancers, self-employed. You get to pick the funds too to be invested in, but just know that this type of IRA, it operates like a traditional IRA, so it's not going to be a Roth. You get at least 20, as of 2022, you get a 25% before tax contribution limit, and that goes up to 62,000 contribution limit, which is pretty tough to get especially if you're a startup company. And as on the other one, the other type of account is a health savings account. Now, some people might not look at, oh, this is not a retirement account. That's okay. You can use it as a retirement account, or you can just use it as a health savings account. That's what it's meant for. So you use it as a tax shelter. So you get triple tax benefit here. And what that means is you get your contribution tax-free. The growth in it is tax-free. And whenever you need to withdraw, only for qualified health concerns, though, expenses, they are tax-free. So it's triple tax benefit. You get a contribution, single person is $3,650, and then for a family or for a couple, it's $7,300. Now, if you are over 55, for almost all retirement accounts, there is catch-up money, catch-up contributions that you can make. Sometimes it's like $1,000 to $2,000. Just know that in this health savings account, withdrawals, they have to be qualified, medical qualified expenses. So you can't just use it to spend money on anything, or you get penalized. So how this can be used as a retirement account is the money grows tax, like a Roth IRA, basically. It grows tax free, and if you absolutely have to use it for medical expenses, then you have a financial option here. So that's awesome. Also, you can let that money grow, just like a Roth IRA. And when we get older, we usually get a little more sick. We have medical expenses start piling up. Then we can start using that money. So a good tip here is try to use your other health insurance to pay in cash from your checking account or whatever, from a different account, and just continue to let this grow. try not to pull from this until you absolutely have to. So now that we know some different retirement accounts, let's look at investing strategies. So retirement investing needs to be conservative investing. If you want to play around with the stock market or with Bitcoin or with NFTs, do that with a little bit of a small portion of your investment income. Don't do it with all of your investing. Retirement investing needs to be conservative investing. We need to understand a risk versus reward here. Definitely know our retirement timeline. So if you're 20 and you're all in on stocks, that's awesome. But by the time you're going to retire, say around 65 or something, maybe start putting that money into safer, more conservative investment funds. If we get into debt again, this is an important piece here. If we get into debt again, pause retirement. Don't invest anymore in retirement and pay off that consumer debt first. So I said consumer debt. So if you have house debt, you can still invest in your retirement. But if you have consumer debt, pause your retirement investing and start paying off your consumer debt. So different styles or different ways we can invest. You can invest in funds, and I'm going to talk more about this in a later video series too. Funds, we can invest in mutual funds, index funds, sector funds, but it's all about, instead of beating the market, it's all about joining the market. Just join the market and earn what the market earns, and you can build wealth there. And you can invest passively, so slowly invest a little of your income each month. Leave a lot of cash aside, put a lot of cash into your investing account, invest in what you know. Stick to low risk assets like CDs, bonds, and funds. So this is why I said you have to understand, your risk management, your risk versus reward here. Aggressive investing, invest more in stocks, commodities, crypto. For the younger people that are already investing in a retirement, most portfolios are probably going to look a little more aggressive, and other riskier investments to take advantage of higher returns. Robo investing is kind of a newer thing. You can automate your investing process through online investment companies, or there's different apps that you can use. And you can preset the certain parameters on how you want to invest. What type of investments you want to be in, what kind of investor do you want to be. You can change it to aggressive, or focus on tech, or focus on healthcare, or focus on you want to have passive income, or you want to build wealth, or you want to focus on dividends, whatever that is, and then the software will do the rest. A good example of this is Acorns. So you can download that app and it'll walk you through a series of questions, and you can go through those prompts, go through those questions, and then they'll invest for you. So you don't have to think about it. It'll take money out of your whatever account that you want to put in there, and then it'll start investing automatically. We can hire a financial advisor. If we simply just need help and we just don't know, it costs a little bit more. This is the most expensive option for sure, because you have to pay them a percentage of how much you're making. But hire a financial advisor, and they'll guide you through the stock market. They'll guide you through the type of investment plans that you need. They'll talk you through your financial goals and your financial status, and they'll help you out. If you pick a good one, they'll help you out in picking the right investments. And the last one, dollar cost averaging, and this one kind of relates more to passive and maybe even funds. But dollar cost averaging, you put a lot of cash into your investment account, and you use that cash, invest a set amount. So just say, pick $100. You put $100 into the stock market, into some kind of index fund, and you keep doing that no matter what happens to the stock market. You do it every month or every paycheck or whatever. You put in $100, let's just say every 2 weeks. Put in $100 every 2 weeks. The market could be up, it could be down. You don't care, because you're dollar cost averaging. Why it's called that is because you're investing in the highs and you're investing in the lows. So you're investing no matter what. And there's some great math studies out there with dollar cost averaging and how it ended up being one of the better options for many people who don't want to be actively engaged into their investments. So how do we get started? First thing I would recommend is meeting with your employer's HR team or finance team, whoever managed that retirement contribution account. Talk to them, set up contributions. If you're not already doing this, start maxing that out. It's usually only a few $100s a week, depending on how much money you make and what job you're in. But definitely talk to them, start maxing that out. Ask them to send you a PDF or a flyer of the account and of the fund manager, and see how much you can control there. Research the investment options at your bank. Usually, many banks, financial institutions, they'll have a whole entire investment branch, and That way you don't have to change banks. Your financial institution's right there. You can go ahead and just move your extra savings over into the investment account at your bank. And then you can check out some independent investing brokerage sites. Now, I put a few here, but there's a lot of them. There's hundreds of different investment options, websites, online brokerage, apps that you can use, all easily accessible. Many of them are free trade. That means you don't have to pay an exchange. You don't have to pay an exchange whenever you buy or sell a stock. You don't have to pay that commission, which is awesome. But all these are great. I would definitely recommend looking ones up that you feel comfortable with, trying out a few. Some of them have some cool benefits packages just to start. They have some good offers, some good promotions going on. So just look these up and some other ones, and maybe you know somebody, talk to them and see what they use. So that's it for our retirement investing step. Next lesson series, we're going to be focusing on paying off mortgages, business loans, and the importance of building up a sizable down payment for a house. And we'll also discuss some maybe rent versus buy scenarios that we'll find ourselves in.